Alright guys, welcome to my YouTube channel. We are still in a series that we have with Bybit, right? And I'm sure that you are kind of wondering what is happening to my screen. Alright, I want to use this video to actually explain the basics of future trading and spot trading. Alright, so now as you can see my screen, right, you can see me and you. I want to use me and you as an example. I want to explain future trading for you so that you can understand. Don't worry, we'll get into practical, but before I get into practical, I want you to really understand the concept behind futures trading, right? Once you understand it, then it will be easier for you to understand the practical aspect of it, right? So now this is me, as you can see, and this is you, right? Now let's assume that this is November, right? And in December we usually have rice, very expensive. I don't know how it is in your country, but in Nigeria normally December rice is always very expensive, right? And it's because of the fact that we have a lot of people trying to buy rice to celebrate December, because December is actually the month of celebration, right? And basically what we use here is the rice. Rice is what we basically use here to do our celebrations and other things like that, especially rice, right? So now, and because of that fact, the price of rice is always gone up December time, right? Now me here, I am scared of the fact that the price of rice is going to be high, right? And I come to you and I said, please, I want us to get into a contract, right? I want us to get into a contract whereby I will pay you $11, right? Now, this is the current price of rice. The current price of rice is actually $10. But because of the contract I want to get into, we now agreed that I'm going to pay you $11, right? So that you can sell one bag of rice for me in December time at this amount, this $11, because I am scared that the price might go up more than that, and you are like, it's not going to go up. Instead of going up, it's going to come down, right? I'm like, okay, since it's like that, please, I'm going to pay you this amount of money, which is $11, but currently the price of rice is actually $10, right? I said I'm going to pay you $11 for me to buy this rice from you. You now say, okay, that's fine, that's a good deal. You now get into a contract, right? And we both sign the contract that by December I'm going to be buying rice from you at $11, right? Currently the price is actually $10, right? So now in December time, two things can actually happen, right? The price can actually go up or it can come down depending on whatever happened in the market. Now let's assume that the price of rice went up to $15 in December time, right? And don't forget that we have already signed a contract, which means that you must sell this rice for me at this amount, right? Which is $11. Now if you sell that rice for me at $11 and the market price is already $15, I've made how much profit? I've made $4 as profit, right? Now let's assume that scenario 2 actually happened, whereby the price of rice now went down to what? To $6. Remember that the contract price is actually $11. I'll lose $5 while you make $5 as your gain, right? Now if this is scenario that actually played out, I will make what? $4 while you lose $4. Now if this is the scenario that played out, right, you make $5 while I lose $5, right? So that is futures trading. From that explanation, let us see what futures trading is all about. Futures trading is a type of financial trading where you agree to buy or sell an asset, right? Remember, a cryptocurrency is an asset. Please take note of that. Don't worry, as time goes on, I'm going to explain that for you to understand why I said cryptocurrency is actually an asset, right? At a predetermined price at a specific date in the future, exactly what I explained to you, right? I want to believe this is very clear, right? So this is the condition that is very, very key, right? The condition states that the buyer must buy the assets and the seller must sell the assets at the set price and date. Remember, the set price is actually $11, right? And the date is actually December. So no matter the market price, right? Now they said irrespective of the current market price, every parties must obey the contract. That is very, very important, right? So now, having known that in an exchange, we don't actually in real life or in an exchange, we trade price movements. In real life or in an exchange, we trade price movements. In other words, we simply predict where the price will go, and if it goes that way, we make profit. All right. Now, in futures trading, there's nothing like an asset that you buy and keep somewhere. Please take note of this. It's only in spot that you can buy an asset. Don't worry, we'll get into that practically so that you can see it for yourself. In futures trading, what we do basically is that we predict price movement, right? Most times you don't know how the price is going to go. So based on your analysis, right, based on your fundamental analysis and technical analysis, you can somehow know where the price is going to go, and you predict. And if you predict it correctly, where you predict that the price is going to go up and the price goes up, right, you do what? You make gain for yourself, you make profit for yourself, right? If you predict that the price is going to go down based on your own analysis, all right, you make profit for yourself as well. That's simply futures trading, right? There's nothing like commodity when it has to do with futures trading that you have to actually buy it and keep it somewhere, right? So let us move on. Then spot trading, all right? Spot trading is where you can actually buy an asset. You can buy an asset like let me say Bitcoin, right? You can buy an asset like Bitcoin, Ethereum. You can buy Solana. You can buy any kind of cryptocurrency which is an asset, all right? You can buy it and keep. Once the price appreciates, you do what? You sell it, all right? So spot trading is the buying and the selling of a financial asset for immediate delivery at the current market price, also known as the spot price. Now, why they call it spot price is the fact that spot does not deal with the future, right? Now, why future trading is actually being called futures trading is because of the fact that it has to do with the future, right? And spot trading actually happens immediately. Let's assume I want to buy Bitcoin. I get into the market and I buy Bitcoin and move on. It's that simple, right? But futures have to predict price. Once it goes the way that you predicted, now it cannot make profit. If it does not go that way, you make losses. All right. So spot trading happens at the spot, while future actually predicts what happens in the future. All right. I want to believe that is clear. So let's move on. So now let's just define some terms that you need to know, so that once we start using it practically, you will not be somewhat confused. So it's important that you know some of these terms. So let's just move on. All right. So now we have long. All right. Long simply means that you are maintaining long position. Don't worry, I'm going to explain that. You are maintaining long position in the market, which means you are predicting the fact that the price is going to go up. The price is going to rise. Right? That is your own prediction. That simply means that you are longing the market, or you are maintaining long position in the market, right? When you predict that the price of the market will go up, it refers to as long position, right? I want to believe that's clear. So short, right, is the opposite of long. When you predict that the price of the market will go down, it refers to as short position, right? You've done your own technical analysis and you've done your own fundamental analysis, and you've come to a conclusion of the fact that the price will go down instead of going up. Then you now short the market, right? When you short the market, that is, you are simply saying that the price will go down, right? And if that happens, you make profit for yourself. And if that does not happen, you make what? Losses for yourself. Right? It's that simple. Okay. Now, in spot trading, we have buy and sell. Right? The same thing with long and short in futures. Please let's take note of this. In spot trading, we have what? Buy and sell. And in futures trading, we have what? Long and short. Right? So let's move on. So now leverage. Alright, this is where it's getting interesting. This is simply trading with more money than you have in your wallet with the intention of maximizing profit. Right? Now, it's only on futures trading that you can work with leverage. In spot trading, you cannot work with leverage. Leverage is not in spot trading, but in futures trading, you can work with leverage. Right? Now, how does leverage work? Leverage actually helps you to trade with more money than what you have in your wallet. Alright, so how does leverage really work? Alright, now if you look down here, you see where I write 5x, 10x, 20x, and what have you. Now this simply means that, let's assume that you have $100 in your account, alright, and you are using 5x. That means you can multiply that $100 times 5. That simply means instead of you trading with $100, you're actually trading with $500. And you know that the higher the amount that you are using to trade, the higher the profits, right? Now let's assume that you are trading with $500 and you are making a profit of 5%, right? You are already made $25. At the same time, please take note of this. Now, if you have a loss, right? If you have a loss of 5% as well, you are already losing $25. So that is the disadvantage of leverage, right? And the advantage of leverage, right? Advantage of leverage simply means that it helps you to make more money, and it can also help you to lose a lot of money and even all your money. This is very important. Now let's assume that you are using 10x, right? You are trading with $100. So you can actually multiply that $100 times 10 and it becomes $1,000, right? So now let's assume that you make a profit of 5%, right? That means you are going to be making $50. And at the same time, if you are making a loss of what? 5%, that means you are going to be losing $50 as well, right? So leverage actually helps you to do what? To make more money or lose more money, and you can even lose all your money. So when you are using leverage in your trading, you have to be very, very careful and make sure that you apply proper risk management. This is very, very important in trading. Don't worry, once we do it practically, you understand better. All right, the next thing we need to consider here is take profit. Next thing we want to consider here is take profit. Take profit is very, very key. All right, now take profit, this is a point where you ask the market to close your trade in profit. Now this is actually most times done automatically, right? Now, and what you need to know about cryptocurrency market is the fact that the price fluctuates seriously. There's high volatile movements in the market. So, take profit is very, very important, right? Because at some point you might be in profit before you know the market goes against you and you'll be in losses. So that is why it is important that you always use take profit for you to actually place your trade, right? Take profit, most times they call TP, right? So don't just place your trade without placing, making sure that you put your take profit. I'm going to do that practically so that we can see how this is being set up, right? So that once it gets to that point where you want the market to close your trade for you in profit, the market can actually do that, right? I want to believe that's noted. So stop loss, right? At the same time, this is when you have to apply a proper risk management, right? At some point, when you have lost some money, you should be able to tell the market, okay, if it gets to this point, close the trade for me, right? I don't want to lose my money more than this. This is very, very important, because if you allow the market can actually go against you and wipe your account out. So it's always important that you apply stop loss in your trade, right? Now they said this is a point where you ask the market to close your trade in a loss. This avoid liquidation, right? So very soon we'll know what liquidation is actually all about. So liquidation happens when a trader's leverage position is forcibly closed by the exchange because the trader no longer has enough funds to keep the position open. Right now, liquidation simply means that your money has finished. That means the market has actually used all your money, or you've lost all your money in the market. Now, once that happens, the exchange actually closes your trade for you at that point because you don't have any money in your account again for you to continue. Right now, that depends on if you were using cross accounts or you were using isolated accounts. So we'll get into that briefly so that we can actually talk about that as well. Right now, cross margin uses your entire account balance as collateral to maintain all open position. It's a situation where all your available balance in your trading account is used for all open trades. Right now, there's something that we have cross account, we have isolated account. Cross account simply means that, okay, you open a trade, right, and you decide to use, let's assume that you have $500 in your account, right, and you decide to use $50 to run a particular trade, right? And since you were using cross accounts, if you, let's assume that you not use stop loss, or where you put the stop loss can actually go beyond the $50, right? Now, because of the fact that you use cross accounts, it will cross into your balance you have in your wallet outside the money you're using for that particular trade. Now, take note of this. Let's assume that you use $50 to trade, right? And you have $500, and you did not put stop loss, or where you put the stop loss was beyond the $50 that you're using to trade, right? And the market finished using the money that you have in your open position, which is $50, right? And because of the fact that you use cross accounts, cross margin to trade, it will eat into that $450 you have in your balance left, right? So that is how cross margin actually works, right? So once you are trading, you know exactly what to go for, right? Isolated margin is when you trade with only the money you put into the trade and not your entire trading balance, right? Now let's assume that you have $500, for instance, and you're using $50 to trade. Once that $50 has gone, you've lost that $50, your market automatically close. It does not eat into your trading balance you have in your wallet, right? So most times I advise that you use isolated margin instead of what cross margin. It's very important. At the same time, also make sure that you use your stop loss and take profit. Is very, very important. All right, we have limit order, right? Limit order allows you to buy or sell cryptocurrency at a specific price or set a price threshold, right? What does limit order simply means? Limit order simply means you tell the market, okay, at this point, right, I want to buy or want to sell my cryptocurrency, right? And we have two types of limit order, which is buy limit order and sell limit order, right? All right. Another concept that you need to be aware of is limit order, right? Limit order allows you to buy or sell a cryptocurrency at a specific price or setting a price threshold, right? Now we have two types of limit order, which is buy limit order and sell limit order, right? So in buy limit order, a specific maximum price you are willing to pay for a cryptocurrency. If the market price fall to that limit or lower, your buy order will be executed. Now, how does this work? Now, let's assume that the price of Bitcoin is actually $10, right? And you set your limit order to be at $7, right? You are like telling the market, okay, I cannot buy this Bitcoin at that amount. I want to buy it when the price has gone down to $7, right? So you now set your limit order at $7, right? And once the price now go down to that $7, automatically, since you have already set it up, the market will just execute and buy the Bitcoin for you at that amount, right? Now the same thing goes with sell limit, right? A specific minimum price you are willing to accept for a cryptocurrency. If the market price rise to that limit or higher, your sell order will be executed, right? Now this is the opposite of what buy order. Now let's assume that you have a Bitcoin to actually sell, and the price of Bitcoin is at, let me say, $7, right? And you're like, I'm expecting the fact that the price of the Bitcoin is going to go up to $10, right? You now put your sell order at $10. So when the price now moves to $10, the market automatically sell the Bitcoin for you at that price because we have already set the sell order, right? I want to believe that's clear. Okay, so let's move on. All right. We're supposed to talk about market order. Market order, right? That actually skipped my mind to put it here. Market order simply means you execute the buy or the sell at the current price in the market, right? Now let's assume that the price of Bitcoin is $10, right? And you want to buy Bitcoin as at that point. Market order, if you are putting the market order, it simply means I want to buy it at that $10. Let's assume that I want to sell as well, and you are using market order. You are actually selling at the price of the market currently. So that's the difference between limit order and market order. I want to believe that is clear. All right. So the difference between spot trading and futures trading. All right. You need to know this. Spot trading has to do with buying and selling of real assets like Bitcoin, Litecoin, Ethereum, Solana, and all those cryptocurrencies that you know about. Why futures has to do with prediction of price movements, right? Now in futures, you predict that okay, the price is going to go up, right? The price of Bitcoin is going to go up. You now predict that the price is going to go up. If that happens, what happens? You make profits in form of USDT or USDC based on what you use in placing the trade, right? So in spot trading, so the second one is that spot trading makes you money when price of the market goes up, while futures makes you money in both ways, right? Now in spot trading, once you buy a cryptocurrency which is an asset and keep, you can only make money if the price of that asset goes up. Let's assume that you buy Bitcoin at $10, right? And the price of the Bitcoin now goes down to $7. That means you automatically lose money, right? But if you're doing futures trading, if you have predicted that the market is going to go down, right, and you're going to make money because of the fact that your prediction is actually correct. But in spot trading, you're actually losing money. I want to believe that's taken, right? Spot trading, you make money only in one way, when the price goes up, right? And in futures trading, you make money in both ways based on your prediction, right? When the price goes up, you make money. When the price comes down, you make money as well, right? Another thing you need to take note of is the fact that in spot trading, you don't use leverage to trade, right? But in futures, you use what? You use leverage to trade in futures, right? I want to believe you understand what leverage actually means, because I took time to explain that. Okay, so in spot trading, we do buy and sell, while in futures trading we do long and short. All right, so let's just jump into practical aspect of it in another separate video. All right, so see you in the next video. Bye bye.